So if we look now at that chart, we see from our ultimate high, the March high, we then got a down move. So we're interested in finding where that down move will go to. So we put on the retracements of the first swing. So that will be the retracements are measured from the March high to the previous low in November. These in fact are weekly bars, but they work exactly the same. And retracement always go backwards. From a high you measure to the previous low. From a low you measure to the previous high. And you can configure your retracement tool. All charting packages have retracement tools, and they have variable settings on them. You can adjust them to configure them to the Danielcode retracement ratios. And these ones I've given you here are just the most frequent ones. In fact, I put on the full Danielcode retracement ratios whenever the charts are updated at the Danielcode website, which is Mondays and Thursdays, and in fast markets that need updating more often, well, I do them more often. Lately I've been doing them sometimes every day, so they're rarely out of date, but for the short time that they are, you should have your own retracement tool so you can update your retracement. Now, the red numbers and the single black number that goes with that sequence, they are retracement measurements when we're trying to find retracement within an established range. The blue bars are extensions. They are outside the established range when we're looking for a move outside the range. If you look at the red bars closely, you'll see that one of them is a little bit darker. It may not have come out particularly well on this chart, but there is one that's a darker red, and that is the 50% retracement. And markets retrace 50% all the time, particularly when they don't know what they're doing. The 50% retracement is the default I do not know setting for most markets. The black line is a particularly strong form of support or resistance. It's the last level of support or resistance in the Danielcode sequence for the operative swing. On longer term charts, we see all markets observing this black line and turning at it. Markets are very loath to break that black line. If you look at your weekly charts of the S&P and the Dow, you'll see that the low came at the black line. The market broke the black line and immediately reversed. That's where it came. Why did that happen? You may say it's because the Fed and Treasury bought in their bailout package. Yes, they did, but where was the market when they did it? At the Danielcode black line. And we see instances of this on daily charts, weekly charts, monthly charts, quarterly charts. It happens again and again and again. So the black line means exactly the same thing. It's another Danielcode resistance or support level within the swing, but it's in black mainly to alert you to the fact that it will be the strongest number, but also to alert me to the fact that I need to create some new numbers. We'll now move to chart 12, and you'll see in chart 11 we put the retracements to the downside. Now moving on from the March high, we've got a low in May or late April. We're interested in knowing now, we want to find the upside retracement. So we put on exactly the same retracements, but this time we're taking the retracement from the April low to the March high. And you'll see we put the sequence of numbers on there, and you'll see the market rallies right up into the highest of the red numbers, which is at 965.50, and I've put a blue arrow there to show you. The market turns exactly at that retracement and starts moving down again. Now, we put on the next level of retracements, and as soon as we see that the market's moved through the previous swing low, we know that we need to put on new retracement numbers, and we need to now go to the next biggest swing. So, following your blue lines for the swing, you can see that these retracements have gone on from the March high back to the June low. So we're now putting on the retracements for that whole. There are two swings in there, but they in fact are one big swing. So we're now putting on the retracements for the major swing, and you'll see we put the red numbers on there, and now we can see all sorts of clarity of how markets have responded to this. The first point, you'll see the first arrow is at the, looks to be the April low. The market came down to 846.60 and bounced straight off that number, went back up into a high, which we got in chart 12 on our upside retracement. It then started coming down. It had a vigorous move down, and in early August you'll see that it stopped just below the 784 retracement number. It then bounced up 2 weeks. This is a weekly chart. Where did it go? Back to the 846.60 retracement number, and that was the high of the rally. Now, you'll see if you look closely that on the way down, the market completely ignored that 846.60 number, and this is an interesting one of the phenomenon of the Danielcode, that when it ignores a number in a sequence, it will often come back and use it from the other side. And that's what's happened here. From the July high, this market zoomed down. It found support at the Danielcode number near 784. It rallied 2 weeks, and where did it go? Back to the old Danielcode retracement at 846.60, and that was the high, and that's the third arrow. It then came down, resumed its downward journey. Where did it stop? 738, just a few ticks above the next Danielcode number. Okay, so just on this chart alone, you can see 1, 2, 3, 4 major turns at the Danielcode support numbers, which we put into the downside swing, and you've previously seen how the upside swing was calculated from our upside support numbers. Moving on now to chart 14. We're still on the weekly chart, but we've moved from the 057 continuous chart to the 2008-12 December chart. It's now the front month. You'll see there we had our low at 738.60, and we saw on the previous chart how we got that. We knew that was going to be the low, and then the market reversed from there and it bounced up 1, 2, 3.5 weeks into the high. Where did it go? It went to the retracement. It went to the 932.40, 932.50 retracement level, which marked the swing from the September low back up into the July high. And we can now see here we've had every turn on the weekly charts at Danielcode numbers. Exactly the same thing happens on daily charts. Exactly the same thing happens on shorter term charts. All the turns in these markets, in every market, are made at the Danielcode numbers. Now, the first thing I hope I'm trying to get through to you is the first thing you need to know is where are these numbers, and you need to have them on your chart and expect to turn at one of the numbers. Now let's move on now to chart 15, and here we're going to look at setup bars and how these markets demonstrate that they're going to make a turn. In this chart, which is December contract for COMEX gold, we can see how the bar that's got the arrow to it came down and it made its low almost exactly at the Danielcode blue number at 738.60. So that's the first sign that we're getting a Danielcode setup bar. The market is showing us that it is recognizing that Danielcode number. Now, bear in mind that these numbers are not known to very many people. I have been working on this stuff since I discovered the Danielcode more than 15 years ago now, and I've used this stuff in my own trading and for clients for many, many years, but I only started putting this out to the public in December last year, and very few people know these numbers. Certainly none of the big institutions use them. Certainly none of the black box programs run on these numbers. It's quite staggering for members of the Danielcode and me, and no one is more staggered with this stuff than I am, or more in awe of it, that markets continually turn at these secret numbers that the markets know but that are unknown to the vast majority of traders.